All right, we are going to go ahead and get started. So I am going to be sharing my screen, and let me just make sure I can do this. Just make sure, hold on. I thought I had figured this out because I practiced before we all got here. Well, that's not working. Boy, oh boy. Well, drive safe. All right, I did this before and I don't know why I'm now struggling. Sorry about this, folks. All right, can you give me a thumbs up, Keith, if we're good? Oh man, I figured it out. I'm an IT genius now. Awesome. Thank you, everybody, for your patience. So tonight we're going to be talking a little bit, and I won't be able to do the chat while we're talking, but I'm going to do tonight. So it is Tuesday, August 26th, and we're going to talk about massive action for massive freedom, your blueprint to create wealth. So again, this is an educational series. Our goal is to provide you with what we believe to be accurate and true, but at any time you always need to do your own due diligence before doing any investing. So a little bit about me. I started passive investing in 2016, 18, pardon me, and sponsoring or mentoring changed my life. So far I've been a limited partner in 20 syndications and a general partner sponsor in 14. We'll talk a little bit about what that means as we get through the webinar.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
So a little bit about Massive Capital. We're a vertically integrated real estate company. We're a developer of Class A retail and town centers, and we're an owner-operator of value-add multifamily. We are very focused in the Texas market. That's where we're all based, but we do have some assets in Denver, Colorado, North Carolina, and Georgia. We partner up with Realty One on the development and triple net and retail space. They have about $300 million in assets under management, and Massive Capital has about $200 million under management. So we do LP equity raising, triple net leasing brokerage, land development, steel frame construction, and then we do have a very active mastermind called Massive Masters. So again, tonight's the agenda. We're going to talk a little bit about, again, what is the syndication, GP, LP. We're going to talk about fear, greed, blood in the streets. We're going to talk a little bit mostly on multifamily today, rental demand. We're going to talk about looking for a balance of risk reward. And then we will definitely have time for some Q&A at the end if you have any questions. So again, we all know the advantages of investing in real estate, but this is a reminder, right? If you invest, if you have your cash, you get no cash flow, no leverage, no real assets, no tax advantages. You get two of them on bonds, two of them on stocks, but you get everything on real estate. So you get the cash flow, you get to use leverage, you're investing and buying real assets, and of course you get some amazing tax benefits. And with the bonus depreciation coming back up this year to 100%, it can be a very powerful tool for tax savings. So a little bit about what is a syndication. A real estate syndication is a group of investors who pool money to buy or develop real estate. Syndications are a way for investors to invest in larger properties that they could afford on their own. For passive investors, syndications are totally passive. How does it work? Sponsors, general partners. So if you remember, I mentioned I've been that on 14 people. I'm part of a team what is experienced real estate professionals who organize the syndication, secure the funding, and implement the business plan. We raise capital from limited investors, which are called limited partners or LPs, and they fund the project and they own a portion of the asset. So let me give you a little math explanation. So let's say we're going to buy a $10 million property and we have no additional costs. We don't need to fix it up. We don't have any closing costs, which isn't true, but I'm trying to do a simplistic view of our presentation here. So we're going to buy a $10 million property. Us as sponsors, we find the property, we do all the due diligence, we negotiate the contract, we find lending for it, We're the ones who sign on the loans and guarantee the loans. And then we're the ones that implement the business plan during the hold period. The limited partners, they put up the cash. So again, we're going to buy a $10 million apartment complex or whatever it is. We're going to get a 70% loan, which is a 70% loan to value. We need to find $3 million more. So we get our investors to come in. Our investors contribute $3 million to the property. We take the $7 million bank loan, the $3 million from our investors, and we buy the $10 million property. So everybody that's interested in real estate understands the power of leverage. But on syndications, leverage is even taken to the next level. So while the passive investors have only put up 30% of the capital, they will actually own 70% of the asset. So again, you own a portion of the asset. Massive Capital, most of our deals are on a 70-30 split. So while we get the money from our investors actually own 70% of that asset. And you actually are a partner in the LLC that owns the property. And again, as a limited investor, you have limited liability. So your capital is at risk, but you have no other risk. There's nothing else that can happen to you. We take all of the loan guarantees. We take everything. We make sure that you are protected. It also allows you to target your investments, right? So you can find people that are doing different types of deals and invest in multiple projects. And we'll talk a little bit more about that at the end. But as a passive investor, you don't have to be an expert in anything. So I was at an event in Dallas today and we're talking about assisted living. Assisted living is a very unique category, and you want to partner with people that know what they're doing. They know how to operate them. They need to do different things. So again, this allows you to pick and choose where you might want to invest. And then again, the returns are directly tied to the success of the property. So we make a dollar, 70 cents of that dollar gets split up by our passive investors. And then how we get paid, we split up the 30 cents of the dollar that's left. And often on our syndications, we even have a preferred where you'll get paid 7% on the investment before we do the split. So there are two types of syndications that happen. There is a 506B, and they are a security. We're selling securities. And for a 506B, you do not have to be accredited, but we must have a pre-existing relationship, and you must be considered a sophisticated investor. So again, pre-existing relationship means that you know me, I know you, we've been talking, we understand each other, and so we know each other. I can offer you this opportunity. To be considered a sophisticated investor, that can come through different terms, but part of my goal here on educating you all is to help you become a sophisticated investor, and I'm always happy to do one-on-one calls with anybody. Now, we are only allowed 35 non-accredited investors into a deal. So if you look at the deal before, let's say I'm raising 3 million and 30 people invest $100,000, you don't have to worry about missing out. But let's say I'm raising $6 million. Well, the first 35 non-accredited investors that get into the deal, they're the ones that get into the deal. Once it's full, there's 35 people, the regulation does not allow us to accept any more investors. So again, as a non-accredited investor, you want to make sure that you're ready to act and so that you don't miss out on an investment opportunity. And then for me, I can't do general solicitation. So on these Tuesday calls, even though you're joining me, we may know each other, I can't present a 506B opportunity. I can only present a 506C opportunity because there are no restrictions on mentioning that deal, but you must be an accredited investor to invest. So again, accredited investor means that you have $1 million in assets, excluding your home, or you have a personal income of 200,000 or a family income of 300,000. Now, for me, there are no restrictions on soliciting. So I can post this on my Facebook, on my LinkedIn. I can talk about it on these calls. I can do email blasts to my entire database. So for example, we have about 14,000 people on our database. but only 6,000 people have been marked that we have that established relationship. So again, if you're not marked that way, you would miss getting the opportunity because we can't send it to you. So very important for you to know that there is no difference between a 506B or a 506C, only who can invest and can I market. So again, I'm going to post my link on the chat with my contact info. But if you're interested in getting on my list, you need to make sure that I have you marked as that. Now, being on my list, does that mean, oh, Trevor thinks I'm going to invest for sure? It does not. What it means is we've established the relationship. I'm allowed to give you some warning that I have an opportunity coming up. I'm allowed to invite you to the webinar when it's a 506B. And we normally have anywhere from 3 to 5 weeks for you to make up your mind and get invested. And again, it is an invest first come, first serve. So if you're interested in that, make sure we connect and that I know you're looking to be an investor. Now, if you're accredited, sometimes it's a good idea not to wait. If you're an accredited investor, but you invest while we're a 506B, you actually don't have to verify that you're an accredited investor. Once it's a 506C, we have to do third-party verification. You have to upload all your documents to a third party, and then you get certified that you're accredited. So again, my statement, I say this every week while we're on this call, if you don't find a way to make money while you sleep, you will work until you die. So again, I know many of you know I've told my story. I was working for corporate America last 20 years before I started doing real estate. I fly indoor skydiving and I was going to work. I was going to work, working every day, getting a paycheck every 2 weeks. Everything was great. And guess what happened? One day they said, oh, Trevor, COVID's happened. We're no longer developing. After 20 years, goodbye. Have a nice day. You're let go. And luckily, I'd already started having my money work for me, but I really hadn't reached the point. So I wish I'd have started a lot earlier. So again, this is a very simplistic view of how you can grow your money. So you remember before we talked about leverage, right? So we're going to buy a property, we're going to get a bank loan, you're going to end up putting some capital in it, you'll be the largest shareholder in it. So that is using the power of leverage and the power of investing in syndications. This one is the power of your money working for you while you sleep. So again, it assumes you double your money every 5 years. I also don't take taxes into consideration. Everybody's in a different tax bracket. I know you may still have to pay income tax, especially if you have a W-2 job. Once you become a real estate professional, it's a lot easier not to pay taxes. Love him or hate him. When Donald Trump was debating Hillary Clinton, he smiled and said, I pay no taxes. And this is why. He's a real estate investor. So again, if you were to invest $100,000 and we doubled it in 5 years, it's two. So if you invest your original 100 and then the 100 you earned, you have 200, and then you turn that to 400 in 5 years. Then you take that 400, you invest it into 800. You take that 800, you invest it, it becomes 1.6 million. You invest the 1.6 million, it becomes 3.2 million in 25 years. Now again, I know that you're going to have tax consequences. There's going to be things that are happening. This is really just to show you the power of compounding your money. Now, if you were smarter, you would take that $100,000 and you would convert it to a Roth IRA. Again, I'm not your tax planner, your financial accountant, and I'm not an IRA specialist. But if you converted it to a Roth IRA, you would actually be growing that $3.1 million tax-free. That's crazy, right? Super, super powerful. And again, power of leverage, and then the power of compounding. I always say investing in real estate is commercial real estate as a passive investor is not a get rich quick, but it's a get richer slower, right? So this is only $100,000 contributed. And then you continue to put that money for work for you while you're sleeping. Now, again, Warren's partner, Charlie Munger, says the first rule of compounding is never interrupt it necessarily. So remember we said you're going to put in 100, earn 100. A lot of people say, well, I want to live off my passive income so I can quit my job. So if you did that, I understand you might have to. But what I want to make sure you understand, you put 100 in, you make two, you live on 100, put 100 in, make 2. In 25 years, how much are you going to have left? 200. So again, at some point, you need to have a pile of money working for you uninterrupted. So again, we talked about Warren Buffett. I turned 65 last year. Somebody sent me a text saying Warren Buffett doubled his net worth after the age of 65. I thought it was crazy. Then I found this amazing slide. And how did he do it? Warren Buffett does it through compounding his money. Yes, he's a smart investor. Yes, he invests in a lot of things that make sense, but he keeps his money moving. He never takes his money out of earning money for him. So again, a lot of people right now are afraid, right? They don't know what's going to happen. There's a lot of craziness in the marketplace. There's a lot of things happening. So people are afraid. And why are you afraid? You're afraid of failure, right? Worry that a new endeavor might not be successful or meet the expectations. You know, you're learning about real estate investing and you're worried that you may not get your money back. You may lose it. You're overwhelmed, right? It's a lot of complexity to understand even as a passive investor, there's a lot to understand the project. So you can get to be feeling overwhelmed. You can also feel, well, I'm going to wait till everything's exactly right, right? I waited for a long time for things to be exactly right. And I'm going to tell you, I never found the time. It just never was exactly right. Self-doubt. I don't really know. I don't know if I know enough to get this done. I don't understand it. I don't want to take a change. Social anxiety. A lot of people I know, when they switch and they start pulling their money out of the stock market and putting it in real estate, it's not normal. Americans don't do that, right? We're told to go ahead, put our money, get a 401k, match on the 401k, let somebody else take care of it. That's what we're told to do. And when we do something different, it's significant. And you're going to have people say to you, what are you doing? Are you crazy? And then you're just going to understand that you may not be able to succeed or contribute effectively. So Baron Rothschild made a great statement, especially with this fear, because right now there's some blood on the streets. I'm not going to lie. And I'm also not going to lie. Some of the blood on the streets is mine. I've had a few deals that have not gone as well. But when he says buy when there's blood in the streets, even if the blood is your own. Now I'm going to go one more thing back to my good buddy Warren Buffett. If you remember, he says, be fearful when others are greedy, and greedy are others are fearful. Well, for those of you that have been watching the news, Warren Buffett just put almost $1 billion into build to rent housing. When Warren Buffett makes a big move, like putting $1 billion, and I know he's worth many billions of dollars, but he doesn't move that kind of capital unless he knows it's time to. So again, rental demand is rising and smart investors are responding, right? So today's presentation, we're going to explore the dynamic landscape of the rental market. We're going to highlight the remarkable surge in rental demand, and we're going to examine key factors driving this trend and the strategic responses being adapted by savvy investors. Our goal is to provide you with comprehensive understanding, current real estate rental landscape, empowering you with actionable strategies to seize the emerging opportunities in this evolving market. We navigate through the data and insights. My goal is that you'll gain some valuable knowledge to enhance your investment decisions and stay ahead in a competitive environment. So again, there's a lot of fear, right? A lot of people are worried about different things. So some of the things that are happening, housing affordability crisis. If I could see you all, I'd ask you to raise your hands, except for those that are driving, but right now I can't see you. Housing has gone crazy, right? The price of housing has gone up rapidly. And then, of course, with the interest rates, it's super challenging. It has put home ownership out of the reach of many Americans. I have another slide that I'm going to show later that just shows how much the gap has happened. I'm trying to get some more up-to-date data because that one ends a couple of years ago. But again, there are a lot of people that no longer buying a home is going to be the American dream. It's just out of reach. They're going to be lifelong renters. There's a lot of things with the economic uncertainties, right? Fluctuations in the economy, including inflation, job instability, and it leads to people preferring to rent versus purchasing a home. So a lot of people say, "Whoa, the economy's this. There's this much unemployment. You know, whether the forecasts were right or wrong and what happened on job creation, there's still a lot of uncertainty. So a lot of people are saying, well, until I'm sure, because remember, I had a job for 20 years. The one before that was with 18 years. And the one before that was 6 years. That doesn't happen anymore, right? People are moving a lot more. So the uncertainty makes them wondering, should I rent a home? Or should I buy a home versus just be flexible and rent one? The post-pandemic lifestyle shifts. The pandemic changed living preferences. Many people with work from home switched where they're living. They became mobile, they became nomads, or they moved from urban centers out to rural centers to be able to get the cost of living down further. So again, a lot of people are moving around, but that moving around is creating great demand for us, and we think it's going to continue. And then, you just have to make sure that you understand that these are things that are going to potentially give you a lucrative real estate investment. So this is the slide. I can't get anything newer than 2022. If anyone ever sees something newer than 2022, I know it's a little bit overwhelming, but the red line on the bottom is basically the American average. So again, America average. So vastly different between rent in Manhattan, rent in Austin, Texas, where I am, rent in somewhere in Oklahoma, rent in California, definitely, but this is an average. And you can see that red line, it was down to in the 70s to 225, and it's gradually continued to increase, right? It's just the way it is with inflation, the economy. But you can see it's a pretty straight line, a little bit of bump in 2022, but then look at the blue line. The blue line is what is the average American paying per month in mortgage? Okay, so you can see in 82, there's a little blip. 2006, there's pretty big blip on the housing bubble. And it actually went below for a period of time in 2010, went below what the rent would be. And then you look now, excuse me, I'm going to sneeze. Excuse me. You look now, the average rent versus the price to buy, 1800 to 20, almost 2700. That is amazing, amazing delta. Again, I can't wait till I can get some 23, 24, and 25 data on a slide like this. I've got to imagine it's even more. So again, the average American, the dream of owning a home is gone. So again, there's I can't talk. Affordability issues, the combination of rising home prices, higher interest rates has resulted in many millennials and Gen Z delaying a home purchase, leading to a greater renter demographic. And I think there's going to be a bunch that will never be able to buy a home. Obviously, the urbanization trends, people moving around, doing different things. Younger folks don't seem to want to commit to something. I'm an older guy, so maybe that's why I say that. And then changing family dynamics, right? Single person households, diverse family structures increase the demand for rental properties that offer flexibility and adaptability. So again, there are some things that are going to happen that are going to affect rental demand, right? The job market recovery, it's very important. And we've definitely been clicking along pretty good, but there's definitely, we need to make sure that we always continue to have a job recovery. And when you're looking for where to invest, always make sure that you're looking for places that are growing versus shrinking. Okay. Population growth, urban regions are experiencing significant population increases, further boosting the demand for housing. So again, I live in Central Texas. Tons of people are moving into Central Texas, right? We're getting all kinds of people. When I used to drive home from my work, I would drive by a field with cows. Now I drive by 30,000 apartments in a light rail stop. It's incredible the amount of development in Austin and all through Central Texas. There's a lot of other places. Florida's really booming. The Carolinas, Georgia, there's some other Arizona, a lot of folks are moving from California, they're moving east. And then of course there's market trends, rising rental prices, declining vacancies in major cities, and they're competitive. There's one other thing I meant to add to this slide and I didn't. To be honest, I didn't quite understand this several years ago, but I've become very acute. You also need to watch the supply and demand. So for example, 28,000 apartments came online in Austin. So Austin was hot, right? Rent, you couldn't find an apartment, you could bump the rents up, you could do everything, and then a whole pile of apartments came online all at one time. And it put a lot of pressure on the Austin market. Now there's still a lot of folks moving there, but the beautiful thing is, or not beautiful, we'll see whose side you're on, but there has been a huge gap now. During 2020 and forward, nobody was putting in applications to do much new development. Nobody was able to finance it with the new interest rates are happening. So there's this big drop now where there's almost no new units coming online. So again, I need to put that as another one that you need to be tracking and watching. You want to make educated decisions, right? So again, we talk a lot about this, the job market recovery, population growth, market rent, rental market trends. So you need to be watching what market you're investing, what's happening, and make sure that you're investing in a great period. Now, it used to be that you would buy an apartment, you would renovate it, and you would charge more. Right now, it's a little bit flat. So this model will come back up again, and it's certainly going to come back when we talk about a lot of the properties that may be into foreclosure or needing to sell because they're not balanced out on their debt. But at some point, you're going to reach where you're going to be able to really do the value add again, right? It's a huge thing. What a lot of people don't understand is if you can take an apartment and you can fix it up. So I've given this example before. We have a 200 unit in San Antonio, and we're getting about an 8% rent increase because we were below market. We're renovating the units, and we're not spending a lot of money, maybe $3,800 an apartment because we've got a lot of good bones in the apartment. So we're just replacing fixtures, sinks, resurfacing the kitchens and the bathrooms, and we're able to get $100 rent bump. So just think of this. Remember, commercial real estate is all about the net operating income. So if we could take 200 apartments and increase the rent by $100 an apartment, that boosts the NOI, and that actually adds $4 million worth of value to that apartment complex. So again, let me think of this. We bought that apartment complex for $16.9 million. And if we could only pull one lever, which was increase the rents on all of the other units without increasing the expenses to operate them, that would produce $4 million worth of value on that particular property. And again, that's how we get to the point where we talked about earlier, where we are doubling people's money. Also, just to be a little bit more flexible, a lot of operators are offering some varied leasing terms. So for example, they're doing some short-term rentals within their units to get this wider range of different people that are wanting to come. Some of the things that we're doing too is we're making sure that we're getting folks to stay. Retention is a super huge trigger for us to pull because of course it costs us money to turn an apartment. We're not collecting apartments while it's turned. So what we might do is a light refresh of their apartment in exchange for them signing a new lease. So, and again, a lot of people are leveraging technology to save money. So they're doing remote locks, they're doing thermostats that are remote, they're doing all types of things. Super efficient. Now there's so many programs out there, and we've started implementing some AI. I wish I understood AI a little bit more, but it blows my mind. Somebody will put in a request for maintenance item, and some AI, I think they're robots living somewhere, ask this person clarifying questions to get more information so that we know what to do and the level of emergency. It's amazing. And then again, also on digital marketing techniques, we have it where we're putting ads, and again, AI technology, robotic, they're answering those ads. They're connecting with those people. They're booking their appointments without any human interaction. So again, these are very powerful tools that sophisticated operators are using to create value. And then I mentioned before about refresh of apartments, keeping them. You want to make sure you're keeping your tenant base happy, right? Also, referrals from your current residents is huge. We had a program once where we said, Okay, you refer one person, we're going to give you $250 off your next month's rent. Refer another person, 250. Refer a third, $500. So we did a big promotion. How would you like to get $1,000 at Christmas? And we actually got about 10 residents that referred those people and got $1,000 gift card. We gave out Amazon gift cards at Christmas. And then obviously you want to make sure that you have responsive property management and that they're doing a good job taking care of your tenants. Got to make sure that you're up to date. I'm not going to go too much into detail on this of regulatory changes, and things have changed. There's a lot of things that have happened. Again, I own some apartments in San Antonio. We used to be able to evict in 3 months, and it's now taking us like 90 days just because some rental laws changed. Different things happened. We were 90 days before in Austin, and they made some changes, and now we're back to 30 and 60. So again, you just want to make sure that you know what you're doing and able to take care of it. So again, you want to make sure that you're continually analyzing everything. You're identifying emerging markets and neighborhoods poised for growth to be lucrative investment opportunities. So again, it's not just enough to say, I'm going to invest in San Antonio. You need to be more granular than that. Where in San Antonio? And again, I'm just using that as an example because I'm very familiar with it. What type of apartment? Where am I going to be? Different things, because you want to make sure that you are going where people are going. And again, short-term rental markets, I already mentioned that. So again, rising rental demand gives significant opportunities for investors willing to adapt their strategies, target high demand markets, enhancing property appeal, leveraging technology, building strong community. Investors should remain proactive in navigating the evolving rental landscape to ensure long-time success. So because I can't share and ask questions, we'll have questions at the end where you can share your experiences. So one of the things I want to talk about is, remember before I talked about that you can pick and choose different investments that work. And it is super important that you have some balance, right? Because the market has some shifts and some changes, right? So one of the things you want to do is you want to look at the risk of an opportunity. And that's super hard to tell, right? Because risk really involves a crystal ball. But again, I want to make sure that you understand that you're looking at things going, okay, this person's offering they're going to triple my money, not double it. Trevor said he's going to double it. Well, maybe they're not going to triple your money, right? That can be very high risk. I've got a couple investments where they're going to 1.5 my money. And people said, well, Trevor, why would you invest in that? Because I want to balance out, right? That one pays like clockwork. It's a triple net lease of a medical center. The leases are guaranteed by doctors, guaranteed by their practice, super consistent. Plus, they put a lot of equipment so they're not moving out of the property. It's also a triple net lease. Triple net lease means that all operating expenses and risks are passed on to the tenant. So again, it's a very low risk. I got an email from the sponsor and it said, oh, we've got this $28,000 bill. But what he didn't say was, don't worry, it's covered under the triple net. So I sent him an email. I want to make sure. And he goes, oh, yeah, absolutely. Don't you love it? And that was his answer back, that that's not our risk. Now, we have to have cash to pay it, and then we bill back and collect it. But it's very easy to be able to do that in those situations. You obviously, everybody's investing for reward, right? We want to make sure that we're being paid. Our money goes to work while we're sleeping. We want to make sure that it's work time. You don't want to have all of your investments all on the same time loan. So if you all of a sudden won that big $750 million lottery tonight, I think it's tonight or tomorrow night, you win that big lottery, don't put everything in the same timeline, right? Look for some things that are 3 years, some things that are 5 years, some things that are seven, maybe even 10, because you want to balance out. That way you can keep your money moving, right? If you move big chunks of money on a similar time zone or time frame, pardon me, and that money comes back, you might not be in a position where you can find enough good opportunities to keep your money moving. Again, the second your money stops moving, it stops working. That other chart I showed, that assumes your money's working 365 days a year. Now, a couple of days here and there aren't going to affect you, but months on end, I've had some folks that have been waiting for a deal. They moved some money out of something and they can't find a deal they like. And I understand that. So they want to wait. So again, make sure that you're keeping your money fluid. And again, when you find something good, I always tell the story. My best investment, they tripled my money in 20 months. I love them to death. The morning that that money came in my bank account, guess what? It went back out in their next deal because I wanted to keep that money working, right? That money wasn't going to do me any good sitting in my bank account. And then different asset classes. So we've talked about it before, right? We've talked a lot about multifamily. And even within multifamily, there's different asset classes. There's A, B, C. Most of my investments are in C or A. I don't really have any class assets. I wish I did. It just wasn't right, right? So the A's were mostly new builds and the C's were value add. But I'm also invested, as I mentioned, in medical center. I'm invested in a new build storage. I'm invested in retail development. I'm invested in buying existing retail and doing a value add plan. So again, you want to make sure that you have some balances and also within that, you have some geographic changes. So I rarely tell people that they should buy. Again, if you understand your hometown market and you really believe in it, then go ahead and do that. I understand that. But you want to make sure that you have some investment diversity, right? So even if it's all in Central Texas, in a couple of major markets or emerging markets, if you're going to invest in the Carolinas, there's a few locations in the Arizona. So just again, make sure you're balancing it out. So when you start to think about investing, a lot of people think, well, I want every investment deal to triple my money like Trevor just talked about. And I hope that you find that, but it's not going to be the case. So if we were a baseball team and you said, well, Trevor, listen, I'm the captain of the team. Every single person on this call, when they get to the plate, their only goal is to hit a home run. Just go for it. Everything. Go for it. Go for it. We all know that we'll never win the World Series, right? The teams that win the World Series have a strategic plan, right? They get a couple of people on first, a couple of people on second. Then they think, okay, this is the right time in the game for me to shoot for the fences and get that home run, get that grand slam. So again, when you're looking at your investment portfolios, when you're thinking about it, we're leaving a moment of distress, but we're about to go to a moment, I think, of great opportunity. Just make sure that you're looking at things and you're trying to be balanced and you're not always looking to swing for the fences and hit a home run. Now, if you happen to be in the Dallas, Texas area, I'm going to be doing a property tour. So we like to do property tours where we show people different types of real estate asset classes. I've actually never been to this property, so I'm pretty excited. This was a pretty small deal, an interesting deal. So you can see in the photo, there are 6 retail locations on the bottom, and there are 18 apartments on the top. This was a Class A in a brand new development. We bought it from the builder. It was about 2/3 occupied. We finished filling it up. But if you want to just come and learn, we do these every month. Sorry for those of you that aren't in Texas. Mostly we do one in the Dallas area, one in the Austin area, and one in the Houston area. But we would do these property tours. Last 2 weeks ago, we were out in Pasadena, went and toured our 200 unit. That was also the first time I'd seen that property. It was one that happened before I joined Massive Capital, but super interesting for you. And it's a great opportunity to be able to join these different tours. If you're interested, just scan that or let me know and I can send you a sign up link. Now, if you're a lady on the call and you've been living under a rock and I haven't told you about She, on the opposite Tuesdays, I'm not talking. Jasmine operates a call called She, and it's all about ladies doing different things. Jasmine's amazing. She's my partner. She's the one that I talk to all the time. And again, I talk about passive, but you need to be actively passive, right? You need to be always educating. I call it earn and learn. So again, if you're interested, I always like helping people, like talking with people, make sure that you understand your investments. But when you do, you invest and we do the rest. I like that statement. If you're interested in becoming active, So I'm an active deal sponsor. We do have training for that. We have a mastermind. I mentioned it earlier, Massive Masters. It's all part of a group. And that's where we train people to become active real estate investors. And again, tonight at 7:15, if you're interested, Phil, who's in the center here, he was my original coach. He does a presentation. I was at a lunch today where he was presenting. So he does a lunch, and then the evening they do an in-person and they live broadcast it. And again, if we do these, if you're interested, I can get you information for that. And again, massive dreams need massive action. You're one decision away from a new life. I hope you decide to take massive action. My goal is to help 100,000 people reach financial independence through real estate investing, and I'll hope you join me in this journey. Now, a little bit of history on the 100,000 people. When I first started this, I was flabbergasted that I was 58 years old and didn't know about syndications and apartment investing. So it became a mission of mine to educate people. So I set a goal of 1,000 people. Well, then I read Mr. Grant Cardone's 10X, actually listened to it on Audible. If you haven't listened to it on Audible, it's a must do. And then follow it up with Be Obsessed or Be Average. I love it. And so I moved it up to 10,000 people. And then once we started growing Massive Masters, I'm a coach on a Texas RIA real estate group. We decided that we would move my goal up to 100,000 people. So again, I hope you're one of them. I'm going to stop sharing. Oh, I see. I got a couple more friends on the call. Let me put my contact in the chat. And you're in Dallas. Awesome, Randy. Let me get the link here for you to sign up if you're interested in coming. I don't know. Can you guys unmute yourself if you want to ask questions? I know I had to unmute Keith to let him talk. So this is next Thursday. The one in, if anybody wants to talk, raise your hand. I think I have to unmute you. They switched my platform. Midland, Texas. Yes. And in fact, I can't talk about it too much, but we were just there doing some, we have a property. We actually have a multifamily in Midland already that's closed and done and doing very well. And we're working on a couple of opportunities there as well. And I'd love to see them. So I would come out there just to see you to do a tour. Any others? And are you able to unmute yourself and ask questions? Put them in the chat or raise your hand if you need me to unmute. And again, I put two links in there. The one link is to all of my contacts so you can connect with me on LinkedIn, Facebook group, or the second one is to book a call. It's good to see you, Natasha. Natasha's my #1 fan. Nope. Up there, I got a heart out of her. Awesome. Any questions? Boy, did I do such a good job? Keith is smiling. I don't know what that means. Here, I'll unmute you if you want.
I see you guys going to be in Rockwall. That's my neighboring city.
That's awesome. Well, come and join us.
I am. I'm coming. I'm registering now.
Awesome. Yeah. So
Are they building a lot of those out this way by the lake?
So I've never been out there, so I don't know. This is the only property we have. And so this one was an interesting one that we found. It was a really good value. And we actually didn't syndicate it. There's only a couple of partners in it. But it was a very interesting opportunity.
Yeah, they're doing a lot of those here with a little shopping strip at the bottom. And so
yeah, and our educational tours, the goals of them is just, let's first of all meet in person, always better in person, and then just come and ask some questions. Every deal we have is nuances, right? So this one has a nuance, right? This one is, we had a couple of tenants to fill and a couple of apartments to fill. And then it's basically, it's a buy and hold, right? Because it's a nice Class A asset. For the retail, it's triple net, so we don't have any risk. Tenants, you always have risk. They could damage a unit and get out. But again, on A-class properties, it's a higher rent. It's a nicer, it's not the same as
Rockwall is very, very nice.
Yeah.
Yeah. You don't have to worry about that in Rockwall.
Yeah. Yeah. And even the person that asked about Midland, we're looking at a property there. The median income's 170,000. I had no idea within a mile, 120 within 5 miles. So they got some money in Midland. Awesome. Well, I hope that we offered some value for everybody here. I really appreciate everybody showing up. Look forward to seeing you next week at the property tour as well in person.
Yeah. Where am I to locate you guys on the property?
We'll just be right out front. You'll see me.
Okay.
It's a small space. I'll just be hanging out front. I always wear my name badge that says Trevor.
Okay.
By the way, Keith, I don't know if I ever told you this, but Keith is my legal name. So I'm actually go by K Trevor Thompson. That's how you'll find me. It
Right.
always pops up as Trevor, but Keith, I was never called Keith. I'm a junior. And
Right.
so when I turned 16, I worked for a guy that used his first initial, thought it was cool. And so ever since age 16, I've been K Trevor.
I don't
Outstanding.
think we can deal with two of y'all, okay? Double the trouble.
That's right. Awesome. Well, I really appreciate everybody joining tonight, and I will see you in 2 weeks. Thanks,
Are these
everybody.
every
You
two
have a good
weeks?
night. Take care. Bye bye.
Bye.